All right, so here's some more problems from chapter 8. So we're going to again be taking a look at the allowance method and aging. So here's exercise 8.7, and again I'll jump to the requirements and then we'll go back and look at the meat of the problem. But they want a schedule to estimate the appropriate year-end balances for the allowance for doubtful accounts, and again they're using the aging approach. And then they want to figure out what the bad debt expense will be for December 31st. And then they make a change to say, what if they change the balance of the allowance? How would that affect your bad debt expense adjustment? Because initially, they're going to tell you that they want the balance to be, or that the unadjusted balance is at 800 credit. And then what would happen if you actually had a balance of a $600 debit, just to kind of show you how that would affect your adjusting entry. All right, so let's first show you the aging part. So notice for the time period that the debt's outstanding, you just take a probability, multiply it by that category, and you come up with your estimate. So 5%, 10%, 20% times the categories, you add them up, you get 1,700. So remember, that is your estimate. That's what you want your bad debts, or that's what you want your allowance account ending balance to be. So to get your adjustment, so notice that you have your allowance account. If they have an $800 unadjusted balance, then you'd have to make an adjusting entry of $900 as your bad debts expense. So 8 plus 9 would give you that $1,700, because remember, that is your desired ending balance, okay? And then in requirement 3, they said, what if the allowance account had a $600 debit balance? Well, of course, if it had a $600 debit balance, and again, you still want that same ending balance of $1,700, you would have to credit the allowance account for $2,300, and that's what your bad debts expense adjustment would be. All right, 8.8. On this one, again, they want us to look at, it looks like some entries, some journal entries for the month of November. And I think initially they're using the percent net credit sales method. So that'll be the first one we do, but then they're going to switch to the aging method. So then we'll do our weighted averages. And then we'll do our adjusting entry. And notice they'll say the allowance for doubtful accounts has a $600 credit balance. So we'll need to take that into consideration. And then we'll show all the various accounts related to the accounts receivable, how they're going to show up on your balance sheet. All right, so let's take a look at the first one. And again, it looks like the percent, let me go back, you kind of missed it. It says estimated that 1/2 of 1%. So don't miss it. It's 1/2 of 1% is your initial estimate. So that's actually 0.005. So if you look at this first slide, what they did was they took that 0.005 times your credit sales. I got $500. That would be your adjusting entry. Again, this is the percent credit sales method. You just take your percent times the sales. That's your adjusting entry. That's pretty simple. Now, in requirement 2, you apply the weights in a table. So again, they gave you the 10%, the 20%, and the 40%. And again, you just multiply by the respective categories. You add them up. The 11,100 would then be your required ending balance for allowance. And then the problem says if you had a $1,600 unadjusted credit balance, the difference is your plug number, and that plug number would actually be your adjusting entry, which would be $9,500. You'd still have the same debit and credit, except it would be for $9,500 once they switch to that aging approach. All right, now, so then the next thing, again, showing how this would be presented again on the balance sheet, you would just simply take your accounts receivable, subtract out that required balance of allowance, and then that would give you your net receivable of $77,900, or you could just show the net $77,900 as one number. There's 2 different ways. It's definitely acceptable to show that on your financial statement. All right, so then next up is they want us to go through and prepare journal entries for each of the transactions. This is going to be for transactions A, B, C, and D. So we've got a bill, we've got a write-off, we've got a recovery, and then we have to write an estimate, and then they want us to show the effects on net receivables, net sales, and of course how that affects your income when you do these entries. So let's walk through the entries. So notice, for a simple billing of a credit sale, you debit AR, credit service revenue for $25,000. That's pretty simple. On part B, this is your write-off. Anytime you write off an account, you will debit the allowance account and credit accounts receivable for whatever you're writing off. And then on letter C, that's the recovery. What you do is you have to reverse the original write-off. So you debit AR, accounts receivable, credit allowance for the amount that you're recovering for the 900, and then you simply just show the collection by debiting cash and crediting accounts receivable for the same amount. And then the last one, they just said, go ahead and record your adjusting entry. So notice that's bad debts expense, debit, credit the allowance account for 500. That's would be your entries you would record. And then the next slide is just going to show you, it'll show you the effects of net receivables, net sales, and income. So again, you just have to know how these are classified. So, you know, with, for example, on the first one, accounts receivable, of course, that's going to increase your receivables. Service revenue, that's revenue, that's going to increase your revenue and income. On part B, you notice on this one, there's no effect on anything because you're just debiting, you're increasing and decreasing your assets. So this, essentially, if you're looking at the accounting equation, you would just show this as an increase and a decrease to your assets. So there's actually no effect on your accounting equation on anything. On this one, you'll notice you are simply increasing your assets because the accounts receivables simply write themselves down. So what initially what happens is your cash position is going to go up by, it looks like $900. And then, let me show you the slide because it's probably hard to see it over there, but you can see that here. So you'll notice that, again, just as I'm going back and forth and showing you these. So you've got your accounts receivable, this 900 and this one sort of kind of wash each other out. And then on this one, you have your cash increasing by 9. This allowance, since it's basically this whole transaction right here, essentially reversed that original transaction when you did that write-off, because you had to establish the receivable again because you'd written it off the books. But then notice right away, you go ahead and take it right off. But because you put that allowance back on your balance sheet, your allowance account actually goes up. So what'll happen is your actual receivables, net receivables, actually go down because you're putting that allowance account back on your books, which is, again, is a contra asset. And then, of course, the last one, it looks like it's just an expense and allowance. And again, you'll see that your receivables go down, and so will your income, because you're putting your expense on the income statement. Again, your net sales is not affected. All right, next one, you've got several transactions, A through J. We'll walk you through these. And then again, you'll notice that what they want you to do is the actual journal entries. They already give you the different percentages. You got the categories. All you gotta do is multiply these percentages by each of these for the aging approach to get your estimate. But again, we'll go through each of these. We'll do the journal entries. We'll look at the accounts receivable. And then I believe there may be an accrual. If there is, we'll show you how that works on if there's interest on this one as well. All right, so on the first one, you'll notice you just simply book your receivables. That's just a credit sale, debit AR, credit service revenue for 200. And then on the next one, they just wanted you to debit your bad debts expense for 2,000. So, and again, let me show you, again, back to the transaction. Again, this one, let me just pause this. I think I'm on the right problem. I think I might have got on the wrong problem here. Just make sure I'm not showing you the wrong one. Yeah, that's the right one. All right. So you'll notice, again, because I want to make sure you're using the right method. For this bad debts expense, it's going to be 1% of the credit sale. So 1% of 200,000 is simply 2,000. So that's where they're coming up with this expense right here of debit bad debts expense and credit allowance for 2,000 because it was 1%. So again, that's the credit sales method problem. All right. So then on this one, it looks like we've got a write-off of a receivable. So you debit your allowance and credit accounts receivable. On letter E, it's just another account, sell on account, or service revenue. So debit AR and credit your service revenue. And then it looks like on letter F, it's another, it's your bad debts expense. And let's go back and check that one out, make sure we got the right method. So on letter F, it says, again, it's 1%. I'm just following, it's 1% of the credit sales. And this was during February. So it's going to be 1% of 150,000. So that's where they're pulling that number in. Again, let me go back. This is letter F. So that's all you have to do is book the debit bad debts expense, credit the allowance for 1,500. Again, that's 1%. And then on the next one was simply just a note. You lent some money out, so you debit notes receivable, you credit cash. And then on letter H, it looks like this was again a recovery of $500. So you simply debit AR, credit allowance for the recovery amount, and then debit cash and credit accounts receivable for what they collected. And then here's the interest. On that interest, I believe it was a March 1st loan that we gave out. And so notice it's principal times it's 10%. And the reason it's 1/12 is because it's March 31st is the end of March, and they lent out the money on March 1st. So March 1st to March 31st would give you 1 month. The total amount would be $100. So that's an accrual. So you would debit interest receivable and then credit your interest revenue for $100. Okay. Now the tricky one is when you get to letter J. So let me go back and let me show you this on the problem. So letter J says they adjusted for uncollectible accounts based on the aging analysis shown on the next screen. I'll go back to the aging. And then they go ahead and just give you what the allowance account is at that point. They're saying, assume the allowance account has an unadjusted credit balance. So that's going to be, you're going to need that to get that adjusting entry on March 31st. So again, under the methods, so what you do is you have to take your individual percentages times these weights. So 2% of 36.5, 10% of 42, 20% of 51, and so forth. Add them up. That'll be your estimate. And then you have to compare it to that $6,000 existing balance. So right here is what they're showing you how they did that. So notice they want an 8390 desired balance, and then 6,000 is the current balance. The difference is going to be your adjusting entry. Notice that's where they debit bad debts expense and credit the allowance account for 2390. And they're also showing you right here how they came up with those estimates, those are the calculations. So again, that's how you do it when you're doing the aging approach. And then the last thing is they're showing you the balance sheet presentation where you have your accounts receivable. There's your allowance account at the end of March. Notice you subtract that to get your net receivable. You had a $12,000 note receivable, and this $100 of interest receivable simply would have been your accrual. All right, and I think that's the last of these exercises.